Hi, Jesse Durham here with you. Today's subject is going to be compound interest. Albert Einstein famously said that compound interest is the eighth wonder of the world. And in fact, he who understands it earns it, and he who doesn't pays it. So let's look at a specific example such as what we've addressed here on the channel before. But just in case you've not seen that, let's say that we were going to procure a vehicle. We're going to make a vehicle purchase for our life, for our business, whatever the case may be. And if we took money that was set aside in a commercial savings account or checking account in a commercial bank, if we took money out of that account, we would then forfeit the opportunity to earn interest on that money. We would have interrupted the interest that was being earned on that money. Whereas, as conceived by R. Nelson Nash in his book, Becoming Your Own Banker, and as is promoted in his book, The Infinite Banking Concept, if you take a policy loan from your policy, your whole life policy that's been properly constructed for banking purposes, you could take a policy loan without having interrupted the premium payments that you've been making to your policy. The company would actually make a policy loan to you from their general account. So your money, your premiums, your deposits that have been paid into your policy, your premium payments, continue to grow at the guaranteed interest rate with that company uninterrupted, but yet you have access to funds for purchasing this vehicle. So there are two different scales that we want to look at. In that example that I've just laid out with your whole life policy and your premiums that you pay to yourself in that policy, those are going to be ascending, meaning that those values are going to keep growing. What you'll actually see is the death benefit continues to grow. And we can address that elsewhere if we don't get to it here now. But the death benefit continues to grow, the cash values continue to grow, your access and everything to that capital continues to grow. So it's uninterrupted because the insurance company will make you a policy loan from their general account. That's the ascending scale. Well, see, the descending scale is what you see on the vehicle itself. So whether you finance that with a third party commercially or whether you finance it with yourself, you're going to be amortizing that amount. So it's going to be decreasing with every payment that you make, either to a commercial bank where they're getting the interest and all the benefit, or if you're doing that for yourself, if you're actually practicing the infinite banking concept and you are recapturing that money with interest for yourself, that's going to be on a descending scale. It's going to be going down. So at the very same time that your premiums continue to ascend and grow uninterrupted, the compounding of interest continues to go uninterrupted, you're also at the same time able to make policy loans for things that will continuously be on descending scales. And again, we took the example of financing a vehicle, but that could be anything. That could be paying off credit cards. That could be paying for vacations. That could be buying equipment for a business. Many, many different situations. It's called the infinite banking concept for a reason, but that's a great example of how having access to whole life policies in a personalized banking system for yourself allows you to benefit from uninterrupted compound growth in your policies. Now, here in a moment, I'll flip screens and we'll take a look at our calculator because I'd like to ask a question. See, when provided with an option, I know that there are certain natural tendencies that we have, but I'd really like to actually look at some numbers with you today. And again, much like in Nelson's book, I personally believe that the philosophies of becoming your own banker are more important than any numbers covered in the book or that I may mention here. But they're not to be overlooked altogether either. So the scenario would be this. Which would you rather have? Would you rather have $1 million today or have a penny double every day for the next 30 days? Maybe we'll say 31. We'll pull it up on the calculator on the other screen here in just a second. But for now, which one of those would you have? $1 million today right away, or a penny that doubles every day for the next 31 days? So food for thought right there. Let's consider that. All right, so here's our scenario. Either 1 million upfront or a penny doubled every day for the next 30 days. So a million is looking really good, obviously, at this point, but we're just going to start punching in the numbers here and see where we land if we take this penny and we just start doubling it without interrupting that process day after day and see the trajectory of uninterrupted compounding. So obviously we're going to go ahead and do some days here times 2. We'll go ahead and do 10 days and you'll see we're still under $1. Okay, just now over $1, a couple of dollars. And after 10 days, so a third of the way through the month, we're at $5.12. And that $1 million is looking really good at this point. But 10 days in, $5.12. We'll probably walk that out for another 10 days and just see how that grows. Again, uninterrupted compounding is taking place here, even though we're seeing some pretty meager numbers in comparison with that million. Okay, we're in 4-digit land now. And when we walk this out another 10 days, we're 20 days in, it's 5,242 and change. So 2/3 of the way through the month, 2/3 of the way through our 30 days, and we've barely broken over $5,000. Whereas option 1 was $1 million up front. But let's keep going. Times 2 times 2. You see these numbers, 83,000, 167,000, 335. Getting close to the end, and we still haven't even cracked $1 million. We're just now going to crack 1 million. But we're not done. We've actually still got a couple of days left. So let's double this 1.3 million and see what we arrive at. That's going to be almost 2.7 million. And if we do that again for our 30th day here, we're going to land at $5,368,709.12. So again, for a long time, for the vast majority of those 30 days, it was not glorious at all. But again, here at the end, here in the long range, which is what Nelson Nash promoted, we get to see the benefits of not interrupting, not impeding the compounding of interest, and just what a great difference that can make. I mean, if we would have taken the $1 million up front, we would have missed out on well over $4 million more dollars that our money could have produced on itself. So I hope this has been a good exercise in opening up our eyes to the great power of compound interest. And then also, something that we need to talk about, because we've already talked about interest and compound growth within our banking policies. That's just a contractual guaranteed growth with every company. It's a unilateral contract that you have with the insurance company that you're with, and there is that. It's guaranteed. It's a beautiful thing. Also, many of these companies, the great ones, the mutual companies that we enjoy owning policies with personally, and I'm not married to any one company per se. I'm married to my wife. I have policies. We have policies in different companies, but these mutual companies with their whole life policies that have been paying dividends for well over 100 years through pandemics, recessions, depressions, world wars, you name it, everything that's transpired over that period of time, they also have paid a dividend. There's been a return of premium. Technically, that's what that is, or a dividend paid to the policy owners, the mutual owners of the company. So also, we have an option with that dividend of what we can do. There's been another video done on dividend options. I would encourage you to educate yourself in that area. Check our channel for that information. Read Nelson's books, of course. Now, I've got one more example to be able to share again, and you can actually find this in Nelson's book. If you look at page 22, he has an airplane example. And here's another great illustration for us to consider compound interest and the efficiency of a policy over the course of time in the long range. So let's take an airplane and put 10,000 gallons, this is just a scenario, but 10,000 gallons of fuel in that airplane. And let's say it's going to fly from the East Coast to the West Coast, or wherever you happen to be. Think of a distance for yourself. And let's say that 2,000 gallons of fuel are consumed in that flight. Well, we've seen a reduction of 20%. There's been 2,000 gallons that have been used up. But remember this, and this is going to be much like a policy. The plane with 8,000 gallons of fuel has the same power. The engines have the same power that they did when there were 10,000 gallons that had to be carried. That's a lot of weight that had to be carried as well. So those engines are just as powerful, and yet the plane will become more and more efficient as time goes on, because it's just as powerful as from the start, but it weighs less and less, so it can go further and faster and all these different things because of the efficiency of how that works. Well, a policy is the same. When we don't interrupt the compounding effect, even though we access the cash values through policy loans, but we don't interrupt the compounding effect by, say, making a withdrawal. A withdrawal would change this scenario that we're laying out here. That's why we choose to take policy loans instead. But that compounding of interest gets to continue and perpetuate, and just becomes more and more efficient. Every policy becomes more and more efficient year after year after year. More cash value becomes accessible. The death benefit can continue to grow as these paid up additions are purchased with our dividend every year. So I would encourage you to relook at that portion of Nelson's Becoming Your Own Banker book. So I hope this has been helpful. If you have a question about this subject or any of the subjects that we cover, again, I encourage you to read Nelson's books, but reach out to us. You can reach me on phone, 828-817-4223. Email is durhamtalents@gmail.com. I look forward to our conversation. Hope you have a great day. Thanks.